Inflation, the gradual rise in prices, and the erosion of purchasing power has long been a focal point in economic discussions. While often perceived as a modern issue, its roots are deeply intertwined with the monetary policies of the past century. From the gold standard's abandonment to the rise of debt-driven economies, inflation's story is as much about history as it is about the present and future. This script delves into the origins of the current inflationary trend, the debt-induced economic shifts, and the predicted decline of the dollar. We also explore historical examples of hyperinflation, the evolving role of technology, the enduring relevance of gold, and potential scenarios for the monetary system. The origins of the current inflationary trend can be traced back nearly 90 years to 1933 during Franklin D. Roosevelt's administration. This period marked a pivotal shift in monetary policy when the gold-dollar exchange rate was fixed at $35 per ounce. By severing the direct link between the dollar and gold, the U.S. government laid the foundation for what would become decades of money printing. This decision was not isolated. It was a response to the Great Depression's economic turmoil, aiming to stabilize the economy. However, the $35 per ounce gold-dollar peg was nothing more than an illusion, sustained through careful monetary management. This illusion finally unraveled in 1971 when President Richard Nixon ended the Bretton Woods system, effectively decoupling the dollar from gold entirely. This moment, often referred to as the Nixon shock, ushered in an era of fiat currency, where money derived its value solely from government decree rather than intrinsic worth. Since then, money printing has become a tool for economic management, allowing governments to fund expenditures and stimulate growth. However, this approach has also set the stage for inflationary pressures as the supply of money has consistently outpaced economic output. The ramifications of these monetary policies became increasingly evident in the decades following the gold standard's abandonment. One of the most notable trends has been the exponential growth of debt, particularly since the early 2000s. National, corporate, and individual debt levels have surged, creating an economic landscape heavily reliant on borrowed money. For the middle class, this shift has been particularly impactful. Once the backbone of economic stability, the middle class has seen its financial security eroded by rising costs, stagnating wages, and increasing reliance on credit. Home ownership, education, and healthcare, traditionally seen as attainable aspirations, have become sources of significant financial strain. Debt, once a tool for growth and investment, has transformed into a widespread burden. For many, it is no longer a means to an end, but a permanent fixture of financial life. This trend underscores a critical vulnerability in the economic system, one that could exacerbate the effects of inflation. The purchasing power of the dollar has been steadily declining, a trend that shows no signs of abating. Over time, this decline makes goods and services progressively more expensive, subtly eroding the standard of living. While this gradual erosion is concerning, the real danger lies in the potential for an accelerated decline. At a critical point, the dollar's value could begin to spiral downward rapidly, triggering hyperinflation. In such a scenario, the cost of everyday goods could skyrocket within weeks or even days, rendering the dollar practically worthless. This phenomenon has historical precedents, but the global reliance on the dollar as a reserve currency adds a unique and alarming dimension. The dollar's role as the world's base currency means its decline would ripple through the global financial system. Countries holding vast reserves of dollars would see their wealth diminish, potentially leading to geopolitical and economic instability on an unprecedented scale. To understand the potential consequences of hyperinflation, it is instructive to look at historical examples. One of the most infamous cases, the Weimar Republic, experienced hyperinflation in the aftermath of World War I. The German government printed vast amounts of money to pay war reparations, leading to a situation where prices doubled every few days. At its peak, a loaf of bread cost billions of marks. A more recent example, Israel faced inflation rates of over 400% in the 1980s. The government implemented drastic monetary reforms, including pegging the shekel to the dollar and reducing public spending, to regain control. While these cases offer valuable lessons, the dollar's potential hyperinflation would differ in scale and impact due to its global significance. The interconnected nature of modern economies means that a collapse in the dollar's value would have far-reaching consequences, affecting trade, investment, and financial stability worldwide. The technological advancements of the 21st century have revolutionized payment systems, enabling instantaneous money transfers and digital transactions. While these innovations offer convenience, they also pose unique risks in the context of hyperinflation. Digital payment systems and cryptocurrencies could accelerate the effects of inflation. In a hyperinflation scenario, the ease of transferring money digitally could amplify panic-driven spending and currency devaluation. Cryptocurrencies, often seen as a hedge against inflation, might gain popularity, further destabilizing traditional monetary systems. Technology has also made global financial markets more interconnected, increasing the speed at which economic shocks can spread. While this interconnectedness can foster resilience, it also means that the effects of hyperinflation in one region could quickly ripple across the globe. Despite being officially decoupled from the dollar, gold remains the foundation of monetary value. Its intrinsic properties, scarcity, durability, and universal acceptability have made it a reliable store of value for centuries. In times of economic uncertainty, gold often serves as a safe haven for investors. If the monetary system were to collapse or undergo significant adjustments, the real value of gold could rise dramatically. Estimates suggest that gold could reach prices of $30,000 or more per ounce, reflecting its true worth in a world grappling with unsustainable debt levels. A return to a gold standard, while unlikely in the current political climate, could provide a solution to inflation and currency instability. By tying money to a tangible asset, governments could restore trust in the monetary system and provide a stable foundation for economic growth. Understanding the nature of money is crucial to grasping its role in the economy. Money originates not from central planning or fiat mandates, but from trade and market actions. Historically, gold and silver emerged as money due to their intrinsic properties such as divisibility, portability, and durability. This natural evolution of money underscores its primary function facilitating trade and coordination in the market. When money loses its value due to inflation or mismanagement, it disrupts this coordination, leading to economic inefficiencies and hardship. Centralized monetary policies often overlook this fundamental nature of money, focusing instead on short-term objectives. However, the long-term consequences of such policies ranging from inflation to currency collapse highlight the need for a more sustainable approach. The dollar's collapse, while alarming, could pave the way for a more stable monetary system in the long term. In the short term, chaos is almost certain. A sudden devaluation of the dollar would disrupt global trade, financial markets, and everyday life. Inflation would skyrocket, and confidence in the monetary system would erode. However, history suggests that such crises also bring opportunities for reform. Potential outcomes include: a renewed gold standard could restore monetary stability by tying currency to a tangible asset. While challenging to implement, it offers a proven solution to inflation and currency instability. The rise of cryptocurrencies and other digital assets could lead to a decentralized monetary system. This approach would empower individuals and reduce reliance on central banks. Governments could implement reforms to stabilize the monetary system, such as reducing debt levels, implementing fiscal discipline, and fostering economic growth. While the path forward is uncertain, the long-term adjustments could result in a more resilient and sustainable economic system. Inflation is not merely a modern economic phenomenon, it is deeply rooted in historical monetary policies and systemic shifts. From the abandonment of the gold standard to the rise of debt-driven economies, the factors driving inflation today have been decades in the making. The predicted decline of the dollar, compounded by technological advancements and historical precedents, paints a complex and uncertain picture. Yet, amidst the challenges lie opportunities for reform and innovation. Whether through a return to a gold standard, the rise of decentralized currencies, or significant monetary reforms, the future of the monetary system will be shaped by our ability to learn from the past and adapt to new realities. The journey may be tumultuous, but it holds the promise of a more stable and equitable economic future.